everyone, and welcome back to Market Insights, a series where we delve into interesting topics affecting equity markets. Today I have with me Jacques and Cornelius. Thank you guys for coming back. So let's spend some time unpacking the narrow market breadth that we've been seeing in the market over the last 5 years.
So the market breadth has actually improved this year. We've seen the top 5 performing stocks on the S&P dominating returns in 3 of the last 4 years, mostly Mag 7. But this year, you're still seeing the same type names. Microsoft, Meta still continues to feature in the list. But Broadcom is a new one. Of course, now one of the $1 trillion club companies. They benefit from the big hyperscalers trying to do their own chips and not being so reliant on NVIDIA. And Netflix also had a stellar 6 months. So the top 5 contributed 4% of the S&P's 6% return. But you actually have 2 Mag 7 companies detracting 2% in aggregate. So Apple and Tesla both declined almost 20% this year. Apple started on an all-time high valuation for them of 34 times forward price earnings. That has now come down to 27 times as the market is losing a bit of patience with them. They sort of have a lack of investing in the AI space. Generating a lot of cash, 100 billion per annum, but not really doing anything exciting with it. Then you have Tesla. Elon Musk's involvement in the government has meant that a lot of people are boycotting the Tesla brand, both in the US, but also in Europe. We're seeing sales decline by more than 40% as China competition has ramped up. So we're seeing nice divergence in the big tech names. And if we look at a sector basis, there's actually been massive divergence on a style basis. So you have some cyclical sectors posting 10% plus returns, so financials and industrial shooting the lights out, while consumer discretionary and energy posting negative returns, as well as a split when you look at defensive sectors with REITs at the bottom, that's property companies, and at the top you have telco companies performing very well. Another sector that lagged was healthcare. So no clear style that outperformed over the last 6 months. And of course, we had this massive sell-off in March, April. And we used that opportunity to close our underweight in US tech from 6% underweight to 2% overweight. We just see amazing companies offering us a very good entry opportunity. So it's nice to have volatility back in the market and a bit of more divergence on a sector and a stock basis.
Brilliant, thank you. You mentioned that you guys bought into US tech. So what prompted that decision?
The US market grabs a lot of headlines for always trading at a premium versus the rest of the world. And the same with Mag 7 and people making comparisons even with the .com, which we don't think is justified. If you look at the history, the earnings performance of the US versus the rest of the world has been much better. And then when you look at Mag 7 and the NASDAQ, those companies have far outgrown the other sectors in the economy. So we think they deserve to trade at a premium, and we utilized that opportunity in April to aggressively buy into those names.
Great, thank you for those insights. Jacques, moving on to you, maybe we could spend some time unpacking the recent Israel and Iran conflict and what that has meant for oil prices.
So we've seen quite a bit of volatility in oil markets the past few weeks, given what's happened between Israel and Iran. And historically, conflicts in the Middle East have had a significant impact on oil prices, especially in the first few months as the market anticipates an impact on oil supply from a conflict, but then it generally gets resolved quite quickly with limited impact on supply. I think what's different this time is that OPEC is sitting on around 5 million barrels of spare capacity, and the US is also very long oil now, right? Having become a major global oil producer, so there's less incentive for them to get involved directly in conflicts in the Middle East. The situation does remain fluid and uncertain, and it's impossible to predict an exact outcome. But our base case was that it was a bit of a flash in the pan, so we didn't chase the oil price by buying into oil producers. Following the recent ceasefire announcement and the decrease in the oil price, we have bought into one of the oil majors that also has corporate action potential through a possible acquisition.
Brilliant. Thank you so much, guys, for the insights today. It's been really wonderful having you back. And to the audience, please look out for our travel edition of Market Insights. We'll explore our analyst insights from their recent travels abroad. Thank you so much, and see you then.